A number is assigned. No ceremony marks it. No institution announces it. It begins operating before most persons know it exists. The number carries no signature. It carries no appeal. It travels faster than the person it describes ever could. Lending institutions adopt the number quietly. No public hearing precedes the adoption. No vote is recorded anywhere. Banks begin sharing the number between themselves. The sharing expands. The number moves through institutions like water through stone. The persons being scored are not informed. The methodology is not disclosed. The system operates entirely behind closed institutional surfaces. A young person applies for a first loan. The institution already holds a verdict. The conversation is a formality. The private company expands its licensing model. Institutions absorb the number into their core operations. The integration becomes structural. The score begins appearing in mortgage decisions. No legislation placed it there. It arrived through adoption alone. Regulators observe the adoption. They do not intervene. The absence of intervention becomes its own form of authorization. The scoring company operates as a private entity. Its methodology belongs to no public institution. It answers to no public mandate. Through the 1990s, the score migrates into automobile lending, then insurance, underwriting, then rental housing applications. Each new adoption requires no new justification. Prior adoption becomes sufficient reason. The system validates itself through repetition. Errors in the underlying data are known to exist. The correction mechanism is slow. Most errors persist for years before resolution. The burden of correction falls entirely on the scored person. The institution that generated the error bears no operational consequence. The score reaches employment screening. Employers begin consulting it before hiring decisions. No federal law prohibits this practice. A person with no borrowing history receives no score at all. Absence of debt is treated as absence of credibility. The system has no neutral position. To build a score, a person must first accept debt. To escape penalty, a person must first incur obligation. The system feeds itself. The three major consumer data repositories operate separately. Their records do not always match. The scored person cannot reconcile them from outside. Legislative review of the scoring system is proposed several times. The proposals move through committee. Most do not emerge. The scoring infrastructure expands into new markets. Utility access, telecommunications contracts, power, security clearance, adjudication. Each integration requires no public deliberation. An older female person disputes an error that has persisted for 11 years. The institution acknowledges the dispute. The record does not change. The weight of a single missed payment persists in the record for 7 years. The weight of reliable payment accumulates slowly. The asymmetry is structural. Medical debt begins entering the scoring calculation. A person with no financial disorder but a single health event is reclassified downward. The medical and financial systems converge silently. The persons most affected by scoring errors are disproportionately concentrated in specific geographic and demographic zones. The pattern is visible in aggregate data. No corrective mechanism addresses it. The scoring company publishes general guidance on how to improve one's number. The guidance does not disclose the algorithm. Improvement requires compliance with an undisclosed logic. Systems that record behavior without explaining their own logic tend to persist. Those who study them long enough begin to see the pattern. Most do not study them long enough. After the 2008 financial crisis, millions of persons experienced score collapses unrelated to their own payment behavior. Foreclosures initiated by lenders depress the scores of persons current on their obligations. The scoring system records the outcome of the crisis. It does not record the cause. The person and the institution appear equivalent in the record. Recovery from a score collapse takes years under optimal conditions. For persons in disrupted employment markets, optimal conditions do not exist. The gap between collapse and recovery widens. Post-crisis reform legislation targets lender behavior. It does not substantially alter the scoring architecture. The infrastructure remains as it was. A new scoring model is introduced. Lenders are slow to adopt it. The older model continues operating in parallel, and in most transactions, it remains the one that counts. Consumer advocacy groups publish findings on scoring disparities. The findings enter public record. The scoring model does not change in response. The Consumer Financial Protection Bureau is established. It gains oversight authority over consumer data institutions. Enforcement action remains limited in scope. Alternative scoring models emerge from fintech institutions. They incorporate rental history and utility payments. Traditional lenders do not adopt them at scale. The largest mortgage institutions in the country retain the legacy scoring model as their primary underwriting tool. Contractual infrastructure binds them to it. Change requires coordinated action. None of them will initiate. A generation of persons enters adulthood having absorbed the score as a given condition of economic life. They optimize around it. They do not question its authority. Proposals to mandate open-source scoring algorithms are introduced into federal review. Industry representatives describe the proprietary model as a form of intellectual capital. The review period extends. A data breach at one of the three major repositories exposes the records of approximately 147 million persons. The scoring infrastructure continues operating without interruption. The penalty imposed on the repository following the breach is settled at a fraction of its annual revenue. Operations are not suspended. The settlement becomes a cost of doing business. Persons who were scored without their knowledge at the time of the breach continue carrying the same number. The breach does not appear in their record. Only its consequences do. The score's authority expands again. Insurance premium pricing in several states now references it directly. A person's driving record and a person's payment history become the same institutional category. Several states pass legislation restricting the use of scores in insurance pricing. Federal preemption arguments, slow implementation. The restrictions do not take immediate effect. The scoring system is now embedded in more institutional access points than at any prior moment in its history. It has never been subject to a comprehensive public audit. No such audit is currently scheduled. Each year the system operates without fundamental reform. Its authority deepens. Institutions build further infrastructure on top of it. Removal becomes progressively more costly to contemplate. A young person today will be scored before they earn their first income. The infrastructure that will evaluate them has been operating longer than they have been alive. The system does not require malice to persist. It requires only that each institution continue doing what it did the day before. Inertia is the mechanism. Reform proposals continue entering the legislative record. Each one joins the ones before it. The record grows. The infrastructure does not change. The number assigned to a person is not a measure of their character. It is a record of their interaction with a system that preceded them. The system does not acknowledge the difference. The infrastructure will still be operating tomorrow. The number will still be moving through institutions tonight. No announcement will mark either of these facts. The system that began without a mandate continues without one. It does not require permission to persist. It requires only that no one forces it to stop.